You think you make logical decisions with your money. The data suggests otherwise. Let's run the numbers. Consider the vast array of choice options presented when selecting modern credit cards or savings accounts. Most consumers assume that having more choices is always beneficial for their personal finance. They believe that a wider selection increases the probability of finding the perfect product for their needs. However, behavioral science suggests that an excess of choices can have the opposite effect. When individuals are presented with too many options, their decision quality often decreases substantially. This phenomenon is known as choice overload. It acts as a clear psychological tax, increasing the cognitive load required to compare and evaluate different financial alternatives in the market. Faced with this cognitive load, our minds often experience decision fatigue. We delay making the choice entirely, resorting to procrastination even when delaying leads to higher fees or lower returns. In other cases, choice overload causes us to default to the easiest, most familiar option. We accept whatever is pre-selected, avoiding the mental effort of comparing alternative products. This choice environment does not preserve freedom, it steers behavior. When financial service providers increase option counts, they can paradoxically lower the likelihood that consumers choose the best product. This pattern becomes clear when we look at how employees select mutual funds in their retirement plans. A plan with dozens of funds often leads to poorer investment decisions. Faced with a massive list of investment funds, many employees select a conservative money market fund. They choose this option because it feels safe in an overwhelming decision environment. While this choice avoids immediate discomfort, it reduces long-term wealth accumulation. The employee misses the higher returns of diversified equity funds because the choice architecture made comparison too difficult. To understand the mechanism behind this behavior, we must distinguish between search costs and choice quality. Searching through options requires time, attention, and significant mental energy every time. When options are abundant, search costs rise. As these costs increase, the probability of completing a thorough comparison decreases, causing us to rely on simplified decision shortcuts or heuristics. One common shortcut is the 1-nen heuristic. When faced with multiple funds, some investors distribute their contributions equally across all options, regardless of each fund's specific risk level. This naive diversification strategy is consistent with effort avoidance. The investor splits their money to avoid the difficult task of evaluating which specific assets match their financial timeline. Another shortcut is status quo bias. When the cognitive cost of choosing is too high, we stick with whatever setup is currently active, avoiding any change that requires effort. This behavior explains why default options are so persistent. The default acts as a path of least resistance, allowing us to bypass choice overload by accepting the pre-selected setting. This passive acceptance is highly common in retirement plan designs. By offering auto-enrollment default settings, providers ensure high participation but lock savers into low contribution levels forever. This outcome reflects bounded rationality. Our minds have limited processing power. When choice environments exceed this power, we choose based on cognitive ease rather than optimal long-term outcomes. Now, let us examine the choice environment design. Choice architecture refers to the structure in which options are presented. Providers can influence your decisions by adjusting this architecture. By offering a vast menu of options, providers can create choice overload. This overload can make the default option highly attractive as it requires zero decisions to accept. This mechanism is clear in subscription services. By offering multiple tiers of service, providers increase complexity. The consumer often accepts the default tier to avoid comparing complex features. Similarly, credit card offers often present multiple reward options. By adding rotating categories, caps, and redemption rules, providers increase cognitive friction, causing consumers to choose suboptimally in the end. One primary reason is option salience. When faced with complexity, our minds focus on the most salient features, like immediate sign-up bonuses, and overlook ongoing fees or interest charges. This focus on salience can shift consumer choices. The provider designs the choice architecture to highlight attractive features, while less favorable terms remain hidden in complex option menus. Another key factor is the implied endorsement of abundance. Consumers assume that a larger menu indicates a more sophisticated provider who offers tailored solutions for every possible customer scenario. This trust in abundance is often misplaced. The provider may expand option counts to appeal to diverse market segments without considering the cognitive burden placed on the average consumer. Under these conditions, choice overload acts as a barrier to optimal decision-making. The consumer accepts a default or makes a hasty choice, neglecting a better alternative product. This mechanism is clear in insurance markets. When faced with multiple health plans, consumers often select plans that are more expensive than necessary because comparison is too complex. The provider benefits from this complexity by requiring consumers to navigate intricate option menus. They reduce the likelihood that savers switch to lower fee or lower cost alternatives. This pattern highlights the importance of choice design. If alternative options are not structured clearly, consumers are much less likely to make a deliberate, optimal selection in practice. This pattern highlights the difference between opt-in and opt-out structures. In an opt-in system, you must actively choose to participate. In opt-out systems, participation is always the standard default option. Opt-out structures lead to significantly higher participation rates. While this structure is effective for increasing enrollment, it reduces the probability that users choose rates matching their actual needs. This friction is amplified when alternative choices are not presented clearly. If finding information requires multiple digital clicks, consumers are much less likely to explore other settings or account rates. The design of the choice environment can shift behavior without restricting choice. By making one path the default, providers steer decisions while maintaining the appearance of individual freedom. This influence works quietly because consumers rarely notice the choice architecture. They assume their decision to accept the default was entirely self-directed and personally optimal in the end. To evaluate defaults fairly, we must consider the boundary conditions. Under some specific conditions, default options are highly beneficial, especially when individuals lack any specialized financial knowledge or experience. For these individuals, researching every investment detail would create severe decision fatigue. An automated default setting can protect them from making costly errors in complex financial systems they do not understand. When financial options are structured logically, the search costs decrease. The consumer can compare products without experiencing decision fatigue or resorting to simple choice shortcuts like default settings. By understanding this mechanism, we can adjust our decision-making. We can structure the environment to simplify choices rather than relying on willpower to navigate complex financial menus in our lives. This shift changes how we approach personal finance. We can design environments that reduce cognitive friction, allowing us to compare options clearly and make deliberate, optimal selections for ourselves. For example, when selecting a card or account, limit your comparison to a subset of 3 options. This boundary reduces choice overload, allowing for a thorough evaluation of features. By filtering the menu early, you bypass the cognitive tax. You can evaluate the remaining options based on core features, rather than accepting the default setting out of fatigue. This method is the core of choice engineering. Instead of navigating a complex choice environment, you design a simplified decision path that supports your long-term financial plans over time. To apply this concept, consider a structural audit. Identify all financial setups currently active in your accounts and evaluate if they are the product of deliberate, conscious choice. If a setup is a default accepted out of fatigue, list the alternatives. By writing down options, you bring the choice environment into focus, reducing the salience of defaults. Next, schedule a specific time to adjust settings. Prepare for the administrative friction in advance, setting aside necessary credentials so that you can complete the change easily without delay. For savings plans, use automated escalation features. These settings automatically increase your savings rate, leveraging inertia to grow your assets over time without constant active decisions in your life. For digital subscriptions, review auto-renew defaults immediately after registration. Changing these options early ensures that you must actively opt in to continue the service when it renews next time. This simple change alters the choice framework. Instead of paying for a service you do not use, you are forced to make a fresh judgment when the term expires. These adjustments help you build a more disciplined environment. By making target choices the default path, you reduce the day-to-day willpower required to sustain your financial plan over time. This approach allows you to override choice overload. By designing a simple decision environment, you ensure that inertia works in your favor, supporting your wealth accumulation goals in life. To apply this concept, consider a structural audit. Identify all active default configurations in your accounts and evaluate if they are the product of deliberate choices. Write down the rates and choices. By listing these settings physically, you bring the choice environment into focus, reducing the salience of the pre-selected default option. Next, evaluate if these active default setups meet your goals. If they fall short, schedule a specific time to navigate the administrative steps required to adjust them. Prepare for the administrative friction in advance. Set aside the necessary credentials and document details so that you can complete the change without leaving the process unfinished. For savings plans, consider using automated escalation features. These settings automatically increase your savings rate annually, leveraging inertia to grow your assets over time. For digital subscriptions, review auto-renew defaults immediately after registration. Changing these options early ensures that you must actively opt in to continue the service when it renews. This simple change alters the choice framework. Instead of paying for a service you do not use, you are forced to make a fresh judgment when the term expires. These adjustments help you build a more disciplined environment. By making target choices the default path, you reduce the day-to-day willpower required to sustain your financial plan. The pre-selected choices around you are design structures, not recommendations. Inspect the choice architecture. Don't fight your brain, engineer your environment. See you next time.